Looking for high quality dividend growth stocks that look very interesting after plunging? Want market beating yield and inflation beating dividend growth? Like the idea of being greedy while others are fearful? Then you have to check out today's video.
He is a best-selling author.
30-year-old Jason Fieber has a plan.
This guy retired at only 33 years old.
I don't know if I know too many people that have accomplished something like that.
He's really kind of a guru when it comes to passive income.
Before I get into today's content, if you want exclusive access to my personal six-figure stock portfolio and alerts on any new investments I make, check out the Patreon link in the description below. The S&P 500 has definitely calmed down. It got off to a fast start this year, but then March came with Jay Powell's aggressive tone and the failure of a few banks. Now we're basically flat on the year for the broader market. However, it's a market of stocks, not a stock market. A lot of individual names are down heavily. And this isn't a bad thing at all. See, price and yield are inversely correlated. All else equal, lower prices result in higher yields. If your aim is to live off of the safe, growing dividend income that your investments provide for you, these lower prices are a gift. Today, I want to tell you about 5 dividend growth stocks that are down 20% or more from their recent highs. Ready? Let's dig in. The first dividend growth stock I have to cover today is Automatic Data Processing Inc., stock ticker ADP. Automatic Data Processing is a human resources management software company with a market cap of $88 billion. Love this business model. Automatic Data Processing provides HR/payroll software to more than 1 million clients across just about every industry imaginable. Automatic Data Processing estimates that its payroll software is responsible for 1 in 6 US workers getting paid. While that's neat, what's really great about the business model is the float. See, it collects a float similarly to how an insurance company collects a float. There's a time delay between payroll capital being collected and checks actually getting cashed. And that delay allows the company to earn a return on this capital. It's a recipe that has allowed Automatic Data Processing to build up one of the most enviable dividend growth track records in existence. The human resources company has increased its dividend for 47 consecutive years. This is a vaunted dividend aristocrat. The 10-year dividend growth rate is 11.7%. And check this out, the most recent dividend increase came in at a whopping 20%. We're talking about one of the greatest dividend growth stocks of all time here. Now, the 2.3% yield won't knock you dead, but this is a high quality compounder, not a high yield junk stock. And that 2.3% yield is 30 basis points higher than its own 5-year average. The payout ratio sitting at 80% based on trailing 12 months GAAP earnings per share does look high, but this business is a free cash flow machine due to very little capex, and the dividend is easily covered. This stock's 22% drop from its 52-week high has created what I think is a rare buying opportunity. This is the kind of stock that just looks consistently expensive and rarely buyable. Years can go by without a buying opportunity, but it's dropped from its 52-week high of $274.92 down to the $213 area may have created one such opportunity. Most of the basic valuation metrics are now at or below the respective recent historical averages. The price earnings ratio of 28.4 compares nicely to its own 5-year average of 32.9, for example. Is the stock cheap? No, not really, but I think it's quite reasonable relative to the quality and growth. The company is guiding for 15% to 17% year-over-year adjusted EPS growth for fiscal year 2023. If you pull up the max chart on this stock going back to 1983, it's up more than 10,000%. It's a monster over the long run. Don't underestimate this one. The second dividend growth stock we have to talk about today is Hormel Foods Corp, stock ticker HRL. Hormel is an American food processing company with a market cap of $21 billion. Very simple investment thesis here with Hormel. We're talking about basic food products primarily based around proteins like chicken. And what do we know about proteins? Well, people have to eat, and with more mouths than ever to feed, that bodes well for food companies. However, there's more to it than that, as people tend to demand more proteins when their means improve. As one of the world's largest providers of proteins, Hormel has a pretty clear path to continued growth, which started all the way back to the company's founding in 1891. That growth pathway also extends over to the dividend. The food processing company has increased its dividend for 57 consecutive years. Yep, another dividend aristocrat. Nearly 60 straight years of ever higher dividends to shareholders. That is the kind of consistency that I really love to see and personally benefit from. Stocks move up and down every day, but when your dividend is only increasing, that makes for sound sleeping. The 10-year dividend growth rate is 13.2%, although more recent dividend raises have been in the mid-single digit range. To compensate for the slowing dividend growth, the yield has risen to 2.8%, 80 basis points higher than its own 5-year average. The 62.9% payout ratio is slightly elevated, but it's not concerning. This stock's 29% collapse in price relative to its 52-week high has led to a more reasonable valuation. Okay, the 52-week high for this one is $55.11. Shares are currently priced at about $39 each. What this has done is it's created a more favorable entry point for long-term investors. To be honest, Hormel has often defied gravity and commanded outrageous valuations, but a disappointing Q1 report, which lowered fiscal year 2023 earnings per share guidance to $1.76 at the midpoint, has only reinforced a year-long correction that has more properly valued the business. The forward PE ratio using that guidance is 22.3. Not super low, but the 5-year average PE ratio for Hormel is 25.9. I'd actually like to see it even lower, but Hormel is interesting again for the first time in a long while. The third dividend growth stock we must highlight is Mid-America Apartment Communities Inc., stock ticker MAA. Mid-America Apartment Communities is an apartment community real estate investment trust with a market cap of $17 billion. So here's what I love about this REIT. It provides shelter, which is an essential need. A lot of real estate is rather discretionary in nature. Think office buildings or shopping centers. Those aren't necessarily required, but shelter, it's a staple that's pretty much required in modern day society. Well, a lot of people either aren't able or willing to buy a house. Houses are expensive thanks to high interest rates and supply shortages. Furthermore, some people like myself don't have children and would really rather just live in a small apartment that's fairly cheap and easy to maintain. That's precisely where this luxury apartment REIT fits in as an investment, as it's catering to this demographic. And it's doing so in hot markets like Austin, Texas, and Tampa, Florida. That's why I think the growth runway here for the business and dividend is very long. The REIT has increased its dividend for 13 consecutive years. And honestly, I believe they're just getting started here. The 10-year dividend growth rate of 5.9% pairs pretty nicely with the stock's current yield of 3.8%. But what's especially interesting about these numbers is that both are better now than they usually are. For example, the most recent dividend raise came in at 12%, and the current yield is 80 basis points higher than its own 5-year average. So you're getting higher than average dividend growth and higher than average yield. Gotta love that. And based on midpoint guidance for this fiscal year's core funds from operations per share, the payout ratio is 61.8%. That's actually quite low for a REIT. This stock's down a jaw-dropping 30% from its 52-week high. That's a bummer for those who bought the stock at its 52-week high of $217.64, no doubt about it. But for those looking to get in now with shares going for about $151 each, the situation has become much more favorable and compelling. Using that aforementioned midpoint guidance for this fiscal year's core funds from operations per share, the forward price to funds from operations ratio is 16.7. That's highly reasonable for a REIT of this quality, providing a basic necessity in fast-growing areas of the United States. The stock's 5-year average price to cash flow ratio is 20, so what usually commands a 20 multiple is now commanding a multiple that's below 17. I think that's quite interesting. The fourth dividend growth stock I'm covering for you today is NextEra Energy Inc., stock ticker NEE. NextEra Energy is an American energy utility holding company with a market cap of $146 billion. NextEra Energy is the largest electric utility holding company in the US by market cap. This utility is just a monster, and it's not just a monster in traditional energy terms, but also renewable energy terms. Hence the name of the company. It's preparing for the next era in energy. In fact, NextEra Energy is also the largest renewable energy producer in the US. But there's more to life than just scale and energy source diversification. There's also the footprint. NextEra Energy is the major electric utility provider in Florida, where the company is headquartered. And what do we know about Florida? It's growing like gangbusters, which is helping the dividend to grow like gangbusters. The utility company has increased its dividend for 29 consecutive years. That makes NextEra Energy a dividend aristocrat. It's one of only 3 utility companies that is a dividend aristocrat, making this company rarer and more special than you might initially think. Also unique is the growth. The 10-year dividend growth rate of 11% blows away the kind of growth you usually get from a utility. The most recent dividend raise was 10%, which is precisely what management has been guiding for in terms of near-term dividend growth. The stock also yields a respectable 2.6%. Not super high for a utility, but the growth more than makes up for that. And even after the recent 10% dividend raise, the payout ratio remains a comfortable 61.1% based on midpoint guidance for this fiscal year's adjusted earnings per share. NextEra isn't cheap, it never really is, but after a 20% drop from its 52-week high, the valuation looks quite reasonable here. Now look, if you're comparing NextEra Energy to a typical slower growing utility, you're already doing it wrong. Like I just said, it's unique in a number of ways. Consider the stock's 5-year average price-earnings ratio of 38.9. Yeah, it always looks a bit crazy, but it looked especially crazy at the 52-week high of $91.35. The stock's fall to the $73 area has made things look more reasonable. Circling back around to that aforementioned adjusted earnings per share guidance at the midpoint for this fiscal year, the forward PE ratio is 24. If this were an ordinary utility, I'd say that's just way too high. For NextEra Energy and its quality, footprint, growth rate, renewables exposure, and dividend aristocrat status, I think it's more than acceptable. The 5th dividend growth stock we have to cover ground on today is US Bancorp, stock ticker USB. US Bancorp is a bank holding company with a market cap of $56 billion. Okay, with all the crazy volatility going on across financials in general, and banks specifically, and regional banks even more specifically, I'd be remiss if I didn't include a regional bank in today's video. Well, US Bank is technically a regional bank, but it's actually one of the largest banks in the US. It exists almost in this nether region between regionals and the big 4, too big to fail banks. One might call it a super regional bank. Regardless of how you classify it, I have zero doubt. Let me repeat, zero doubt that US Bank will be just fine a week from now, a month from now, a year from now, a decade from now, etc. The bank runs that hit a few specialized banks that mistakenly got wrapped up with and overly focused on crypto and startups have nothing to do with the likes of US Bank. And so I think the dividend and the growth of it is just as sure as it's ever been. The bank has increased its dividend for 12 consecutive years. You know we're in strange times when bank stocks are offering yields that eclipse the likes of your usual high-yield suspects like utilities and REITs, but that's what we've got going on now. The stock's yield is 5.3%. To put that in perspective, its 5-year average yield is 3.3%. What an incredible spread there. And with a 10-year dividend growth rate of 10.1%, you're getting plenty of dividend growth on top of that high starting yield. The payout ratio of 52% indicates no issues whatsoever with the dividend, despite the headlines and hoopla. This stock looks materially undervalued after a stunning 37% drop from its 52-week high. And much of this drop has occurred over just the last few days as of the time of shooting this video. The 52-week high of $57.92 has completely evaporated. The stock's pricing of right about $37, which is getting pretty close to where it was during the worst of the pandemic, is almost inexplicable. Unless you see a risk of sudden failure, which I don't see, this institution is available for a valuation that almost defies logic. Our last analysis and valuation video on the bank estimated its fair value at $57.54 per share. That analysis is due for an update, which I hope to get on pretty soon. Meanwhile, this could be one of the best buying opportunities that's ever existed for this high quality bank. Thanks so much for watching. I hope you enjoyed today's video. Give us a like if you did, and let us know in the comments what you think about these 5 dividend growth stocks that are down 20% or more from their recent highs. Please make sure to subscribe to the channel and ring that notification bell so you don't miss out on new content. Also take a look at the description box below for some important links, including a link to my personal stock portfolio. This six-figure portfolio, which I call the Fire Fund, generates enough passive dividend income for me to live off of. It allowed me to retire in my early 30s. I've made my portfolio entirely accessible over a Patreon, and I also post alerts there whenever I buy or sell stock. I put my money where my mouth is, and I'm often invested in the same high-quality dividend growth stocks that I make videos on. Over the years, I've heard from thousands of investors who've been profiting from many same exact stocks that I own. So if you think this is something that you could benefit from as well, check the link in the description to see my portfolio and start getting my buy and sell alerts. I'll see you next time.